What's up, Facebook, YouTube, and all the other places you might be watching? Guys, if you're not subscribed to the Roughneck Real Estate YouTube channel, please go subscribe. If you're not watching there, please go watch on YouTube. It's going to be the only place I'm left on the internet. I'm on probation everywhere else. So, anyways, I woke up this morning and right off the bat, I see this article at 5 o'clock in the AMs, and I am intrigued. I got to know what in the hell is going on. So this is the article that got my juices flowing this morning. This is pretty wild to me. The Fed to reset the U.S. housing market through a difficult correction. Okay. I was astonished by this. I cannot believe that this is, I don't know that it's government policy. I don't know how closely tied the Fed is to the government and all that, but this is wild to me. This quote. So this was on Wednesday that he said all this. So I need to say, if you're a home buyer, somebody, or a young person looking to buy a new home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. Okay. I have no idea what that statement means, but this one right here is pretty telling. When I say reset, I'm not looking at a particular specific set of data. What I'm really saying is that we've had a time of red hot housing market over the country where famously houses were selling to the first buyer at 10% above the ask, even before seeing the house, that kind of thing. So there's a big imbalance between supply and demand. Houses were going up at an unsustainable fast level. So the declaration in deceleration in housing prices that we're seeing should help bring prices more closely in line with rents and other housing market fundamentals. That is a good thing. For the longer term, we need is supply and demand to get better aligned so the housing prices go up at a reasonable level and at a reasonable pace so that people can afford houses again. We probably in the housing market have to go through a correction to get back to that place. There are also longer running issues with the housing market. As you know, it is difficult to find lots and now close enough to cities. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a business cycle standpoint, this difficult housing correction should put those housing markets back into a better place. This is wild to me. Okay. So interest rates are not really high right now. I mean, they're not. It's just historically, if you go back to, I think the first time they tracked it's like 1820, and you look at it, really only interest rates had ever been lower than they are right now at one point in time. So these are not high interest rates historically. But when you look at inflation and you look at every other factor that goes into this decision, it's like, okay, is inflation real? Absolutely, inflation's real. Where did it come from? Is it supply chain constraints? Is it because they printed $6 trillion? Probably a little of both. Supply chain should be working itself out, but with wars and nonsense in China, it takes a little while to get supply chain domesticated or in Mexico or to a closer area where, you know, things aren't going to be so far away and so painful to get, right? But what I do see is energy prices are at an all-time high, like your electric bill, gas prices, everything else is at all-time high. Does that add to inflation? Absolutely. When you look at the 9% increase in inflation that they're giving it, which is probably actually higher, do you think it's actually going to go away? Do you think after printing $6 trillion, after realizing that supply chains that are whirled away and China and overseas and everything else are maybe not sustainable in a black swan event. They're building a like $17 billion chip factory down in Taylor, Texas right now, trying to bring supply chain home. So there's a ton of data out there that says, you know, supply chain probably is an issue. The money that they printed probably is an issue. So how could you possibly make this thing go away by raising interest rates, by making it harder for people to do business with each other? I don't really know. But month over month, inflation is no longer going up. They've kind of cured it on a month over month. I think the 9% increase, I think we're at a new normal for pricing in pretty much everything in our daily lives. Prices go up. They very rarely go down. This is something that I did not expect the Fed to be paying attention to. Housing stock. But we'll get back to it. We'll go back to where it is. So to where the information is. So this is a pretty this is a pretty telling article if you go read it, but they got some backside data on here. So when you read all this, it gives you some markets that are going down in value. High cost hubs like San Jose down 10%, San Francisco down 7.8%. This is just little short term data. Austin's market's down. Dallas market looks down. You know, Clean and Temple, I guess, are down. I don't really know. I didn't dive into this too much. But what I did see was the Fed researcher quotes right here. Okay, so the Fed research quote says right here, finding that the pandemic housing boom was driven by a demand surge, not supply constraints. Well, let's dive into that. So when I clicked this link, it took me to a Twitter post. And that Twitter post took me to here. Okay. Volatility in home sales pricing, supply or demand. Okay. Abstract. Now this is, I don't know who Elliot is. I don't know who Dangle is, but they wrote, and we're going to go look at that paper, and I skim read the whole 60 pages of it. Okay. It is wild, but we're using a housing search model and data individual home listings to decompose fluctuation in home sales and price growth and supply and demand factors. Simulations of estimated models show that housing demand drives short-run fluctuation in home sales and prices. While variation in supply plays only a limited role, we consider two implications of these results. First, we show the reduction of supply was a minor factor relative to increased demand in tightening of housing market during COVID-19. New for sale listings would have to have expanded by 30% to keep the rate of price growth at pre-pandemic levels, given the pandemic era surge in demand. Second, we estimate that housing demand is very sensitive to changes in mortgage rates, even more so than comparable estimates for home sales. This suggests that policies affecting housing demand through mortgage rates can influence housing market dynamics. This is something your average wholesale guru on Facebook could come up with, probably without even looking at this data. But the data, if you're a nerd and you want to read 60 pages of fucking nonsense, I think they even made up a new term. I have never heard this term before in my life. I think it's something like, we'll go get the actual term. We'll pull it up. This was a wild read. I skim read it, and I was thinking, man, the smartest people in our government were working on this and reading it and looking at all the data, and they're looking at CoreLogic, and they showed their work. They put a bunch of math problems in here that only Hami can do. This is wild to me, but not one place in this whole 60 pages they mention where the demand came from. They did not mention, they mentioned that there was an increase in demand, and there was no doubt that there was an increase in demand, but they never mentioned where the demand came from. Let me know in the comment section below if you think the demand came from average home buyers or where you think it came from. Let's discuss it in the comments. So right here, right now, I'm scrolling to the top of this thing. There's only one piece of data in here that was really, really compelling to me, and I should have had it brought up before I got to this point. But I'm going to show it to you as soon as I get there. Let's get back over to it. This is a very, very, very long, exhaustive read. It is very, 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 very long. And the one part of data in here that was somewhat interesting was that every point in interest rate raised will result in a 10.4% decrease in sales activity. I believe that's what it was. Sales activity was all they're really tracked in here. They didn't really go into pricing. But the one thing that they didn't talk about in this entire paper, where they wrote the abstract at the front, they did all this great math. Here it is. We estimate that a 1% increase in the mortgage rate lowers housing demand by 10.4%. Okay. Now, in the previous paper that we just watched, or that we just read, you just watched me read. You can go, I think I put the link somewhere. I'll put it somewhere. Doesn't really matter. I'll get the link. Maybe I can throw it in the comment section. Anyways, you can go read this Fortune article. They say that Jerome Powell cites this study right here that these two great people put together for the reason why he's going to raise interest rates until there's a housing correction. Guys, he said housing correction. It appears they are now basing Fed policy not on inflation, but on getting a housing correction across the finish line. What does that mean? He didn't really define it, but they basing it off of this paper that says we do not have a supply issue. We had way too much demand. Well, where did the demand come from? Let's dive in. Let's see. Oh, yeah. From the professional investors that are flooding into residential real estate assets driven by valuations and growth rates. Now, what they're saying is that it's driven by valuation and growth rates. Valuation and growth rates driven by appreciation. Is that what evaluation and growth rates means? Seems like that's a fancy word for appreciation. Professionally managed money is flooding into the rental space. The rental space. While individual landlords have been buying properties for rent, we've also seen a lot of professional money getting to the buy to rent space. Investment giant BlackRock bought Home Partners of America for $6 billion. Other major investment firms have raised money to purchase rentals. Guys, institutional money jumped into the marketplace in 2021. Why did they jump into the marketplace in 2021? Because of the out of control inflation, which means, according to their very own research that they never cited where the extra demand came from, they have wiped that out. The institutional investors are no longer there. If they tip the scale to the other side for the correction they want, guess what's going to come back? The institutional money. They are the smartest people on planet Earth, our federal government. And they're creating a policy to where they're trying to curb inflation and all of these things, but they're basing it on housing data. And the very cliff that they'll push you off of is what will drive into institutional investors back in the marketplace. This is a crazy, crazy chicken or the egg scenario. I cannot believe that Fed policy is being based on housing data, not overall inflation. I think, when you print $6 trillion and you won't take any credit for the harm that you did, this is it. I think we're at a new normal. I think they're going to make a mistake here if they keep raising interest rates, because builders will not build any more new inventory. Sellers will be less likely to sell because they won't be able to they don't want to give up their low interest rate to go into a higher interest rate. And think about it. Why do people sell their houses? Maybe they're looking to upsize. Maybe their family's growing. They're wanting to get a bigger house. They will no longer be able to do that in an affordable manner with higher interest rates. Maybe the prices do come down, but I doubt they do. The majority of what drove prices up were hedge funds paying cash for houses. They're now out of the marketplace. You did your job, Fed. Quit looking at this data and going, oh, we're going to help out the average consumer. You won't. You need more housing stock. People need to build more houses. There needs to be more rental stock. There needs to be more supply that comes online, not less. Okay. If you're going to keep pushing, you're just going to push institutional investors back in the marketplace. I don't know what their overall goal is, but this body rocked me this morning when I read this. And then reading into the rest of the data that this article was based on, or what the federal policy, the Fed's policy was on this, I was absolutely shocked. It was good math. Great read, but they did not talk about the institutional buyers. They're giving the institutional buyers no credit for the surge in demand. And quite honestly, I don't know how high they're going to go with interest rates. Like I said at the beginning of this, interest rates aren't even high right now. But if they do keep going higher, I mean, you're just going to create this crazy. I think there'll be I don't want to put this on the internet yet, but I'm going to say it anyways. I think it'll push a rent bubble. I think right now, for what we're getting for our own properties for rent isn't necessarily unsustainable for us, but like the bottom part of affordable rent, used to be $600, $800 a month. Now that money's almost $1,000 a month. Is you put anything out for almost $1,000 a month and it rents up in 10 minutes. I mean, it's crazy how fast stuff is renting. And I think they're going to create really make rents really high and maybe unaffordable. I don't know if that's the right word, but they're going to shrink households. You know, they're gonna have a lot of unintended consequences for their own policies. So, what article, David? It's this article right here, this Fortune article. Boom, boom, boom. This one, it's a Fortune article. Shares the title of this video: "The Fed to Reset the U.S. Housing Market Through a Difficult Correction." Guys, this is very important in your business model. If I'm reading this right now and I'm a house flipper or a wholesaler or somebody that's very transactional in real estate, I would try. You will get better discounts in the future. They are bound and determined to destroy the value. We buy, and it's always been our thing that we buy sub $150,000 houses. We've got a few outside of that little hard rule that we had. We bought, I think we've got like a 2,000 square foot house we paid 175 for and stuff like that. But that house is renting for $2,500 a month. I would try to figure out a way to buy houses and be able to hold on to them, because it appears they're going to make the U.S. a renter's market, okay, a renter's nation for the short term. And then once they lower interest rates back down, you can refinance or whatever you need to do then, but you'll be able to get deep discounts, hold them long term, build your wealth. You've got to flip that over. If you're a flipper or a wholesaler, you got to figure out how to do that. We're actually going to try to help y'all with that. I don't know when we'll have it up and going, but we're developing all of our banking relationships, getting really tight with about 5 or 6 banks. And we're going to help some of the new people transition into buy and hold investors, because I think a lot of the things that they're not doing right now in their business, whether from a bookkeeping perspective or understanding that, you know, when you go buy this car in your business name, how that negatively affects your business. I think there's some bad practices that wholesalers and flippers have that they would need to clean up to be able to really make themselves lendable, to be able to hold rentals long term. But if you can get in here in the next year and pick up 30 or 40 houses at this deep discount that the Fed's going to give you, okay, when interest rates go back down and they let housing correct back up to where it is now, then you'll have built all that wealth through appreciation by buying when everybody else is afraid to buy. And guys, the institutional money is out of the marketplace right now. Make no mistake about it. They are sitting there. They are banking on this. Who do you think they have lunch with? Who do you think the CEO of BlackRock eats with? Who do you think pulls the purse strings of this whole deal? They knew this months ago. They knew this was going to be the policy. They knew this was what's going to happen. I think there was an article being circulated around that BlackRock was raising like a $50 billion fund to go after houses. You don't want to be buying when those guys are buying. You want to be able to negotiate the deal that you need using the noise that you have, which is the raising interest rates and housing crash and everything else, to be able to buy now. And you want to sell to those guys as the market goes back up. Everybody that got out of market during COVID and quit marketing and all that stuff, they missed the biggest batch of appreciation on planet Earth, and some of the hardest marketing, hardest to find a deal, to get a deal, because all your sellers were like, oh, I know what my property's worth. I see the news and all that. It was very difficult to negotiate. But when you did get deals, you could turn them around and make money. So you need to set yourself up so you can buy and hold during this time period, during this lull. And then from there, anyways, I got to go. I got to jump off of here. I'll see y'all in a little bit. Just got a message on Facebook.